Okay, let's start with a really basic question. How do you make a company more valuable? For a long time, the folks running big companies thought they had a secret weapon, some clever financial engineering. But then in 1958, this one academic paper came out and just dropped a bombshell on that whole idea. And believe me, corporate finance has never been the same since.
So before the late 50s, you have to understand, corporate finance was kind of more of an art than a science. You had executives relying on tradition, on gut feelings, to answer the biggest question they had on their plate. How are we going to pay for all this stuff? And it really all boiled down to this one deceptively simple question. Is taking on more debt a good thing or a bad thing for a company? I mean, on one hand, it seemed like a pretty smart way to boost your value. But on the other, it just felt super risky. And for decades, nobody in the financial world could agree on the answer. And both sides had some pretty good points, right? The pro-debt crowd would say, look, debt is cheaper than selling off stock, and the interest we pay is tax deductible. So for them, the conclusion was obvious. More debt means more value. But then the anti-debt camp would fire back, warning that debt just piles on risk and raises the odds of going bankrupt. Everyone was desperately searching for this mythical, optimal balance, this perfect recipe of debt and equity that honestly no one could ever really pin down. Then came 1958. Two professors, Franco Modigliani and Merton Miller, they published a paper that just completely shattered this old way of thinking. It was a huge deal, a genuine rupture in economics, and it all kicked off with one totally radical claim. They said, in a perfect market, it makes no difference whether a firm is financed by debt or by equity. Just let that sink in for a second. All debt, all stock, or any mix you can imagine, they argued the total value of the company just doesn't change. Now, to the financial world of 1958, this sounded like absolute heresy.
The formal name for this whole idea is capital structure irrelevance. And what it's really saying is that a company's value comes from its actual business. You know, the quality of its products, its operations, the cash it generates, not from how it slices and dices the ownership between lenders and stockholders.
And this beautifully simple equation really captures the whole bombshell idea. The value of a firm with debt is exactly the same as the value of an identical firm without debt. Modigliani and Miller's big point was that all this financial engineering, it doesn't create any new value. It just moves it around. But how could that possibly be true?
Well, the logic Modigliani and Miller used was built on this incredibly powerful concept called arbitrage. See, they realized that pretty much anything a company can do with its finances, a smart investor can just do for themselves.
I love this analogy. Just think of the company's total value as a pie. Now, the company can slice that pie up. It can give a fixed piece to the lenders, the debt holders, and the rest goes to the stockholders. But here's the thing. No matter how you slice it, you don't actually make the pie any bigger. The total value is the total value.
And this gets us to the key insight, something called homemade leverage. It's a fancy term for a simple idea. An investor can just create their own leverage at home. So check this out. Let's say a company takes on a bunch of debt to make its stock look extra juicy. A savvy investor isn't going to fall for that and pay a higher price. Instead, they can just go buy the stock of a similar company that has no debt, and then just borrow money themselves. And voila! By doing that, they've perfectly copied the company's financial structure and get the same risk and return all on their own. This process, this arbitrage, it ensures that you can't just create value out of thin air by playing with paperwork.
Okay, so right about now you're probably thinking, hang on a second. In the real world, how much debt a company has obviously matters. And you know what? You're absolutely right. And Modigliani and Miller, they knew this too. And this is where their theory goes from just a cool thought experiment to a seriously powerful tool for understanding how finance actually works.
See, the theorem forces us to ask the right question. If the mix of debt and equity doesn't matter in a perfect world, a world with no taxes, no bankruptcy costs, where everyone has the same information, then the reason it matters so much in our messy world must be because of those very imperfections.
The real genius of the M&M theorem is that it's not trying to be a perfect picture of reality. It's a benchmark. It creates this perfectly clean, frictionless world so we can then see exactly where the grit and friction of the real world, the things that actually matter, start to have an effect.
And here they are, the big ones, the real-world frictions that make all the difference. You've got things like corporate taxes and the costs of going bankrupt, which are kind of obvious. But then there are trickier ones, like asymmetric information. That's the simple fact that managers know more about the company than investors do. And agency problems, which are just conflicts of interest between managers and shareholders. These are the things that actually create or destroy value when you start playing with debt.
So, let's circle back to our baseline equation. In that perfect, frictionless world, the value of a company with debt and one without are identical. Clean and simple.
But now, let's add just one of those real-world frictions back in: corporate taxes. Because interest payments can be deducted from taxes, debt creates this valuable little thing called a tax shield. And suddenly, look, the equation changes. The value of the leveraged firm is now equal to the unleveraged firm plus the value of that tax advantage. Miller's theory showed us that yes, financial structure does matter, but only because of these specific identifiable frictions like taxes.
The impact of thinking this way was just enormous. I mean, it didn't just tweak a few ideas here and there. It gave us a completely new architecture for how to think about corporate finance.
So the whole journey kicks off with that bombshell paper back in '58. It gets refined over the years as Miller keeps digging into the effects of all these real-world frictions, and it all leads up to 1990, when Merton Miller is awarded the Nobel Prize for his foundational role in basically creating modern financial economics.
And that right there, that was the ultimate legacy. The entire field of corporate finance just pivoted. The game wasn't about finding some magical debt-to-equity ratio anymore. Instead, it became about strategically managing those real-world frictions, how to minimize taxes, how to avoid bankruptcy, and how to get the interests of managers and shareholders all pointing in the same direction. So it all leaves us with this one last question, right? If all those financial tricks don't really create value, where should we be looking for it? Merton Miller's work gives us a crystal clear answer. A company's true worth isn't found on its balance sheet. It's in its business, its people, its innovations, its efficiency. The financing, well, that's just the packaging. The real prize is always what's inside.